Today, our goal is to understand earnings season and gaps. I'm going to show simple and advanced low-risk, high-probability strategies for trading gaps and introduce different perspectives on how to manage gap trades. Earnings season is an unpredictable wild card where anything can happen. It can make or break a chart pattern, and 4 times a year, the fundamentals can really move the price of a stock. Patterns that develop after earnings can be very profitable, and the reaction to those earnings can show a total shift in mentality, emotion, and attitudes towards a stock. It often presents many challenges to investor psychology because earnings season is a time of uncertainty, and as uncertainty grows, it can stir up emotion, and those emotions can be difficult to manage. When stocks report earnings, we want those results to meet or beat the basic Cancelim metrics. In other words, we want large or accelerating earnings per share, sales, and return on equity. It's great to see stability and consistency in sales and earnings growth, and it's always encouraging to see increasing profit margins. There are several things you want to consider during earnings season. First, consider how stocks that have reported recently are behaving, especially those in the same industry groups as stocks you currently own or are interested in. Listen to conference calls to know the company better. Remember, it's the reaction to earnings that matter, not the results. Did the company beat, meet, or miss expectations? And how significant was it? You can have strong earnings and sales, but if guidance is weak, it can cause the stock to fall. Even if earnings per share, sales, and guidance are good, price can still drop if it falls short of Wall Street's expectations. And it's critical that price and volume dictate your buy and sell decisions, not emotion. Small gaps aren't important. If price opens within or near a stock's average true range, it's still trading near recent support and resistance areas. You won't see people making rash decisions or panicking to get out of the stock. Price action after small gaps can be really choppy because some investors will try to add to their positions, while many day traders will try to fade it. Big gaps, on the other hand, virtually reset the charts as price breaks through the most recent support and resistance areas. It does represent a significant shift in attitudes, motion, momentum. It's a shift in balance, and that change in supply and demand can create a tremendous opportunity for investors. If there's a lot of traders who have shorted the stock and are trapped in it, it can create a momentum trend over the next few days as they try to cover their position whenever the stock dips or pulls back. A big gap up would be any move that's greater than its average true range or about 5%. The bigger the gap, the better, and it's not uncommon for the day's range of the gap to act as future support or resistance. Small gaps are usually inside the prior day's range, less than the stock's average true range, frequently on low volume, subject to adding, vulnerable to fading, and very susceptible to chop. Here we have 2 examples, JP Morgan and Cisco. JP Morgan had 2 small gap ups. Both were inside the prior day's range. The first one was less than 20 cents. The second one was less than 10 cents. Both were incredibly small, below average volume. Cisco was pretty much the same thing, at a small gap up within the prior day's range. The gap itself just over 20 cents, and it was on small volume. Here are 3 examples of big gaps. With large gaps, it's especially important to pay close attention to the volume, where price closes in the day's range, and whether the stock is in an early or late stage base. Here we have Splunk, Biogen, and Volcano. What I want you to notice in these 3 examples is that the gap is large, 9%, 7%, 16%. Volume is large, 912% above average, 289% above average, 320% above average. They all have strong closes in the upper half of the day's range, 81, 71, and 60. The 2 that gapped up were in early stage bases. Splunk had just moved past a second stage base. Biogen gapped up out of a second stage base, and when Volcano fell, it had already fallen below the 50-day moving average, which is an IBD sell signal. A lot of people new to investing will ask, should I hold or sell during earnings season? And stocks can gap up or down in reaction to earnings, and reactions can be very severe. So it's important to focus on risk, not reward, when managing your portfolio. It's prudent to take a defensive approach. When placing stops, you want to make sure they're good till canceled and that they can be filled outside of regular trading hours. If you'd done this with Netflix, you could have greatly minimized your losses. Even if you had watched it after hours and were prepared to sell it if it moved against you, things can move unbelievably fast when earnings are reported, and losses can pile up in the blink of an eye, so you have to be careful. You also want to follow all your IBD rules. As you can see with Netflix, it gapped down 25% on huge volume, but if you'd been following your CanSlim rules, you wouldn't have been in Netflix, because after it failed to break out of a first stage cup with handle here, it fell below the 50-day moving average, tried to pop back up and fell back below again. When stocks fall below the 50-day moving average and are unable to get back above it, that is an IBD sell signal, and that could have kept you safe. Facebook gapped up out of first stage base consolidation over 26% on huge volume and had a strong close. So what should you do? Should you sell or should you hold a stock during earnings season? It's important to manage your portfolio defensively. You want to make sure you know when earnings are reported. You want to watch your stock's chart pattern and be aware of its support and resistance areas. You want to know how your stock has reacted in the past. Whatever you do, don't ignore earnings reactions. There are going to be breakouts and there are going to be breakdowns, and you need to be aware of what's going on. Don't hold your stock into earnings without a 15 to 20% profit cushion. Before earnings are reported, cut any losses and take any gain that's 15% or less. At the very least, take partial profits. It's often best to sell positions or take your partial profits 1 to 2 days before they report. And if you own a stock that's reporting after the close, make sure that your stop is good outside of regular trading hours. Remember, you can always buy shares back if the stock reports favorably. The most important thing is that you focus on the risk and not the reward. In part 2, we're going to cover gap basics. For those of you who aren't familiar with the gap, it's simply when the open is higher than the previous high. This was yesterday, this was the high, and this is today's open. You have this little jump in price, this gap. Same for a gap down, except it opens lower than the previous low. So if this is yesterday, that's the low, it jumps or gaps down below it. Strong closes indicate strong demand, especially with huge upside volume. IBD defines a strong close in the upper 50% of the day's range. I prefer the upper 25 to 30% because I'm looking for definitive conviction among buyers. Weak closes can be more susceptible to closing the gap or to fading and chop, particularly if the day's range was large with weak volume or the gap was small. If you have a gap down and it closes in the lower range of the day, there's a high probability that price will continue to fall. If you have a gap down with a strong close to the upside, there is the possibility that it could close the gap. However, to determine the likelihood of this, you need to look at volume. You want to make sure you know all the different gaps and understand the difference between them. A common gap is meaningless and you don't want to trade it. It usually occurs in a trendless market. Price may gap up or down one day but quickly fills the gap in the next few days. There's usually no new highs or upward trend after the gap occurs. They typically have light volume, however the volume can be large on the gap day, but usually it returns to normal in a couple of days. And it doesn't represent any significant conviction of buyers or sellers, which is what we're looking for. A continuation gap usually crops up in the middle of an uptrend or a downtrend. It signals the continuation of the trend. The price will make new highs without closing the gap. Volume is usually very high. When you see a continuation gap, you want to look to add or enter a position in the direction of the gap. It's a good idea to place a protective stop within or below the gap. If it's truly a continuation gap, the price won't backtrack to fill it. And it usually marks the halfway point in an upward price move. Breakaway gaps. After price trades for several weeks or months in a certain price area, you'll have a large gap up, usually 5% or more. Large breakaway gaps outperform small ones. They indicate a seismic shift in supply and demand. They occur on heavy volume, at least double the average daily volume. And after the gap, price can continue to trend for several days. Numerous things can happen after the gap, so it's wise to confirm the gap before entering. Best performance comes from breakaway gaps in bull markets near yearly highs. And the last one we're going to look at is exhaustion gaps. They resemble and commonly occur after continuation gaps. If the gap fills quickly, usually within a week or so, it's likely an exhaustion gap. It'll occur in the direction of the trend and marks the end of that trend. It's not uncommon to see exhaustion gaps in climax runs. The gap may be unusually wide on high volume, and it may or may not be followed by new highs. Shortly after the gap, price will consolidate or reverse direction. So what does a gap represent? Ordinarily, it's an unexpected, drastic reaction that'll push price away from recent price levels. They represent a break in price continuity and a seismic shift in the fundamentals of a security, or they may mean nothing. But gaps do occur frequently in stocks. If the gap doesn't fill within a few days, then more than likely more money will flow into the stock in the coming weeks. Furthermore, gaps often become price support or resistance. For example, if you have a stock gap up, you can put your stop a little bit below the gap. Now, when it comes to gaps and growth stocks, you don't need to be afraid to buy top-rated stocks that gap up around earnings. Sometimes a powerful market leader will gap up 5 or 10% more past its pivot from a proper base on good news. That's a great opportunity to buy it. But keep in mind, in a poor market, most gaps tend to get filled. But in a market with a solid uptrend, any company that's got strong earnings and sales and they're growing rapidly, those companies are going to become a magnet for institutional investors. When a stock gaps up, you're given a great opportunity to get into a stock that may have been overextended from a proper chart pattern prior to the gap. However, you want to remain cautious with stocks that are in late-stage bases. Now, gaps can seem risky or scary to buy. You may feel like you've missed the boat and that the price is now too high to buy safely, but that's not the case at all. Big gaps can often lead to even bigger moves up. Facebook gapped up out of a first-stage consolidation over 26%. It had a big gap, big volume, and a strong close, and it continued to run higher and higher and higher. Vistaprint gapped up 20% inside a first-stage flat base. It consolidated for a little while, but remained above the 20-day moving average, which is a sign of strength, and then started to move higher. It was a big gap on big volume with a strong close and an early-stage base. Exactly what you want to see. Gap downs can lead to big losses, so I want to stress the importance of always following your CAN/SLIM rules. Doing so will keep you out of most trouble. Lululemon formed and failed to break out of a late fifth-stage base. Then it fell below the 50-day moving average, the red line, and was unable to get back above it. Avoiding late-stage bases, capping losses at 7 to 8%, and selling stocks that fall below and stay below the 50-day moving average are all CAN/SLIM rules. And by adhering to those rules, you can avoid being in lagging stocks where gap downs are likely to occur. We're going to explore 3 simple strategies for selecting candidates and entering gap trades. The first is cross your fingers. You're basically just jumping aboard, and it's like flipping a coin. Ready, Set, Go gaps have 3 simple requirements to help increase your probability of success. Buyable gaps have even more specific filters. For all candidates, we want to start with fundamentally strong stocks. We'll pick leaders or potential leaders with consistently increasing or accelerating earnings per share, sales, and margins. Even though we're narrowing our focus on trading gaps, we're still going to pursue stocks with the CAN/SLIM traits. This is F5 in 2010. Earnings per share, sales, and margins are all accelerating. And you can see it's a company that's involved in an innovative industry, potential for continued growth. After you find a stock with CAN/SLIM qualities, maybe it was a ticker that you found in the IBD 50, sector leaders, or stock spotlight, or some other feature in the paper. If the market's in a confirmed uptrend, then you just jump into the stock when it gaps up. Remember, following your CAN/SLIM rules can keep you out of those big gaps to the downside, like we just saw a few moments ago in Lululemon and Netflix. After you find a quality candidate, you can jump in when it gaps, but it's even better when the gap is large. It's also better when more traders who have shorted the stock get trapped. It's better when it gaps above multiple month highs or overhead resistance with above average volume and closes in the upper half of the day's range. And you always increase the odds of success when you follow your CAN/SLIM rules. This is Netflix in 2009. Earnings per share, sales, and margins are accelerating. It's also in an innovative industry with opportunities to grow and expand its customer base. This is Ready, Set, Go gaps. What we're going to do is take all the better ifs, like big gap, large volume, and strong close, from the cross your fingers and jump aboard approach, and turn them into specific entry prerequisites. The requirements are fundamentally strong CAN/SLIM candidates, a market in a confirmed uptrend, a gap greater than 5% or greater than the 20 to 30-day average true range. I prefer the 30 because it is a statistically more relevant sample size. Breakout volume 40% or more. When you have an above average breakout in volume, it's telling you that buyers have decisively gained control of the stock. Since most retail investors are afraid to buy gaps, often institutions are the one pushing the price up with conviction. We want to see strong closes in the top 25 to 30% of the range. It's even better when it gaps out of a base or a recent resistance area, above old highs, or bounces off a key support or moving average. This is Netflix in 2010. Its average true range was just over $2. The stock gapped up about $10 or $11 on strong volume and had a strong close. When it gapped up above the 50-day moving average, which is this red line. It also gapped up out of a base, and it gapped up past a previous high and resistance area. That's a sign of a strong gap up. This is Herbalife in 2011. Earnings per share, sales, and margins were accelerating. The weight loss industry is huge, with collective revenues around $20 billion. So at the time, there was a lot of profit potential here for Herbalife. With a Buyable Gap strategy, we're simply making some small modifications to the Ready, Set, Go approach and adding 2 additional requirements. Our candidates will be fundamentally strong or leading stocks, the market in an uptrend. We want the stock to gap up from a solid uptrend or constructive consolidation. The price should gap up 0.75% of the stock's 40-day average true range, and volume needs to be 150% or more above its 50-day moving average. Additionally, the gap must hold above the intraday low. Herbalife gapped up in February and May of 2011. In February, the average true range was 69 cents. The stock gapped up about $5 or $6. In May, the average true range was 82 cents, and the stock gapped up about $7. Both gapped up on strong volume, and both had strong closes. When it gapped up in February, it was out of a second stage flat base. When it gapped up in May, it was from a solid uptrend. As you can see, price held above the gap intraday low on both occasions. Apple, Baidu, and Google all met the cross your fingers and jump aboard, ready, set, go gaps, and Buyable Gap entry prerequisites. In October of 2004, Apple gapped up about $3 or $4. In 2010, Baidu gapped up approximately $35. And Google in 2013 jumped up almost $90. So what do all these stocks have in common? They were all fundamentally strong CAN-SLIM candidates. They all had big gaps on big volume with strong closes, and they all held above the gap intraday low. I highly recommend that you study past winners. It's a great way to accelerate your learning and ultimately increase your profits. Here are two more examples from 2010, Priceline and Jazz. They both had big gaps on big volume, both had strong closes in the upper 50%, and that meets IBD's definition of a strong close. I prefer a close of 25 to 30%. Notice how they both consolidate for a few weeks after the gap up. Why did they do this? Perhaps it was just digesting its gains. It's common for stocks that have large gaps of 15 to 20% or greater to consolidate for several weeks. But most likely the culprit is the general market. If you scrutinize the S&P 500, you'll see it's starting to turn downward. Priceline and Jazz held up above the 20-day moving average while the S&P pulled back. That's a significant sign of strength. Priceline increased about 52% before the stock made an 8% pullback to form a second stage flat base. And Jazz went up about 144% before it finally pulled back about 33% to form a third stage flat base. Here are two more examples, Green Mountain Coffee Roasters in 2011 and Biogen in 2007. Notice when Green Mountain Coffee Roasters gapped up, it was on huge volume and had a strong close. The stock held above the intraday low, managed to find support at the 20-day moving average before it gapped up again and continued its advance. I'm including Biogen to demonstrate that gaps don't have to be picture perfect in order to work, and to highlight how the health of the general market can affect a gap up and the price action following it. After Biogen gapped up, it did undercut the intraday low, but relative to the market, it held up very well. Observe how it found support at the 9-day moving average while it consolidated. If you didn't buy the gap, the good news is you could have bought the stock as it broke out from its flat base. Here's a simple gap check summary. First, you want the market in an uptrend. You want to choose fundamentally strong or leading stocks. You want stocks that gap up from a solid uptrend, constructive consolidation, or early stage base. It's great when stocks gap above a recent or multi-month or multi-year high, overhead resistance, or bounces off key support or a moving average as it gaps up. Gaps should be large, either 5% or 3/4 to 1 average true range or more. You want to see institutional volume of 40 to 150% or more above the volume's 50-day moving average. Closes should be strong. The top 50% is okay, but the top 25 to 30% is even better. And you like to see the gap hold above its intraday low. This is Netflix in 2009. It is not a lagging stock. It's not below the 50-day moving average. It's not in a downtrend. It's not in a late stage base. What it is a fundamentally strong stock with CAN-SLIM traits. Prior to the gap up in January in 2008 and 2009, Netflix rose 50%. On January 27th, it gapped up about 9.5%. Notice while the market turned downward, Netflix was able to maintain support at its 20-day moving average. It's a sign of strength when gaps are able to hold above their intraday low or a shorter-term moving average like the 10 or 20-day. We're going to look at a much more discretionary advanced gap strategy. This approach adds a layer of confirmation and probability that can provide you with the confidence you need to enter a gap. Basically, what we're going to do is we're going to be waiting for a consolidation or a range to develop over a few days or weeks after the gap, and then we're going to go with the breakout above that range. The gap to the first pullback is a range you want to focus on for new support and resistance. Other advanced gap strategies can be based on your post-analysis or your study of historical precedent. Maybe you notice that the gaps tend to really work only when a stock is in a first or second stage base. That could be worthwhile knowledge to incorporate into a strategy. You can also learn a lot from historical precedent. Maybe after going back and studying gaps, you've noticed that they don't do well in a late bull market, but they tend to do really well in an early bull market. You can take that information and turn it into a rule or a setup requirement. Here's some gap terminology you should be familiar with. Gap support and resistance is the high-low range of the day's gap. A gap test is when price tests new support or resistance of the day's gap range. When a stock gaps up and continues to move up for the next several days, that's a gap and go. If price continues to close higher 2 or more days in a row, you want to look to the first pullback to act as support. The first pullback support and resistance is the high-low range of the first pause in momentum. The first pullback in price after the gap up is often an inside or a doji day, and the pullback will usually happen 2 to 5 days after the gap. A pullback test is simply when price tests this new support and resistance of the first pullback after the gap. And a pullback is any day closing with a lower close. It can be an up or down day, but as long as it closes lower than the day before it, it's a pullback. Before you enter a gap, you want to see price proving its strength. And how you do that is by looking for evidence of support and price being able to break resistance. Suppose a stock gaps up and it continues to close higher over the next few days. When a stock pulls back, you want to see support kick in somewhere in the day's range of the pullback or the day's range of the gap. And after price pulls back and finds support, you want to see that it has the ability to rally upward, break resistance, and move into new highs. So after a stock gaps up, where are you going to draw your new lines of support and resistance? Well, you can do it at the gap high or the gap low. Here are 3 different examples. First, we have a bar chart, then we have candlestick charts, and then we have a MarketSmith chart. An alternative place that you could draw support and resistance lines are the gaps open and close. You can draw your new resistance lines at the gap low, high, open, or close, or any combination that seems logical. It ultimately depends on the range between the high and low and the open and close, and the distance or difference between all 4. Where would you draw new support and resistance for the first pullback? You could draw them at the high and low of the first pullback, or you could draw it at the open and close of the first pullback, or any combination that seems logical. Let's examine some support and resistance basics. After the gap up, price is eventually going to pull back or reverse to test some kind of new support. The logical and common places for support and resistance are the gaps open, high, low, or close. Here's an example of using the gap high and low as potentially new support and resistance lines. Here's an example using the open and close of the gap day as potential support and resistance lines. Because the high-low range of the gap is so large, we're going to use the gap low and close in this instance. Here's an example where we use the gap open and high as our potential support and resistance range. Other logical and common places for support and resistance are the first pullbacks open, high, low, and close, or any combination that seems logical. What we're trying to do is create a zone or an area where potential support and resistance might be, as opposed to a line in the sand. When a stock gaps up and continues to close higher for the next couple of days, the first pullback becomes extremely important to watch. It often becomes a new area for support and resistance. After the price gaps up, it's going to pull back and test one of these new support areas, and if it's successful, meaning that support holds, it can present a low-risk opportunity to enter the trade. Now sometimes neither the gap range or the pullback range will hold. When that happens, the next logical place to draw your line of support and resistance would be at the pre-gap close and high. Something to keep in mind is that the more support and resistance zones are tested in a short time frame, the more likely price will be to break through it. It's a good habit to become defensive after 3 tests of support or resistance. If a stock falls back and tests support 3 times, it has the potential of breaking that support and falling through. Conversely, if price is testing a resistance area, and after 3 attempts fails to break through that resistance area, that could be interpreted as a sign of weakness, and you want to be cautious. In a nutshell, this strategy is just a simple way to determine price support and strength after the gap occurs. It's especially useful for gaps that aren't picture perfect and fall a little short of what we like to see with the ready, set, and go or buyable gap requirements. After the gap, eventually there will be some kind of a pullback. New support and resistance areas after the gap are the gap range, the pullback range, and the pre-gap range. Obviously, the pre-gap range is the least desirable of the three. After we see support kick in, we want price to prove its strength to us by breaking potential or established resistance and following through into new highs. Let's look at some condensed examples. Keep in mind we're focusing in on support areas and zones. Pullbacks can be days up or days down. What makes it a pullback is a lower close than the prior day. When is a pullback over? When it finds support and resumes its upward advance. We want to see price find support and break through resistance into new highs. After gapping up, this short high-low range becomes our first potential area for new support and resistance. The next day the stock rises and closes higher. After the gap up, once price pushes higher, the first pullback becomes the next potential new support and resistance area. Notice how after the stock pulls back, it finds support at the pullback low. See how the first pullback high, which was resistance, now becomes support? Here's a gap with a large daily high-low range compared to the open and close range. Because it's so wide, we're going to draw support and resistance at the gap open and the low of the day. The gap continues to close higher the next 2 days before it finally starts to pull back. It ends up finding support around the gap low. When a stock pulls back, you want to ask yourself, where does price catch itself? Where does it quit falling? Where would the next logical place be? If support hadn't kicked in here, the next logical place would be the pre-gap high. Here's a gap and go example where you have follow through to the upside the next day. You want to wait for price to settle down, and you want to wait for confirmation of support before you enter. When a stock gaps up and continues to close higher for 2 or more days, that's a sign of institutional support. In other words, 1 day wasn't enough for institutions to get into the stock. So after the gap, price inevitably pulls back. Because price falls below the open of the gap, our next logical place for support would be the low of the gap. Once price finds support, continues its advance, and breaks through the resistance of the pullback high. What could have been resistance is now support. The wider the gap up in the range of the gap up day, the more we're going to focus on the first pullback for support. The next day, we have our pullback. Although it closed as an up day, it's considered a pullback because it has a lower close than the day of the gap. We take the high and the low of this first pullback and we create this support zone. The gap low to the pullback high is a range you want to focus on for new support and resistance areas. You can clearly define your risk by using the gap low and the pullback high as potential support areas. Once that support is confirmed, you have a low risk entry. Notice how the stock found support at the first pullback. Then once it broke through the resistance of the first pullback, what was resistance now becomes support. In this instance, we have a gap up. We use the gap low as the first logical place for support. The second potential support zone will be the pullback low. Price does find support here, and what used to be potential resistance is now support for the stock. Here we have the second pullback, and because support holds, it's a low risk entry. What is confirmation? Confirmation when price bounces off a new or recent support area, for example, the pullback range or the gap range. In other words, it fails to fail by finding support. Then it breaks through a recent resistance area, which could also be the gap range high or the pullback high. After an initial test or retest of support, we're looking for the stock to break out into new highs. Maybe we even have 2 pullbacks and support holds both times. But support isn't enough. We want to see price break through resistance and move into new highs. Heavy volume and strong closes can also be a form of confirmation. When you have wide range bars to the upside, accompanied with heavy volume and strong closes, that can be a really positive sign. Some people will define failure if the stock violates a support area, while others will wait for it to close below that support zone. When price closes below the support zone and then the next day undercuts that low, I consider that failure. Remember to put your stops far enough below support to avoid the noise. You've got day traders and market makers and many more who want to shake you out. It's always important to know your risk and not change it. You need to decide how much you're willing to lose and to stick with it. With CanSlim, your maximum loss should be 7 to 8%, but often you don't have to lose that much when you're trading gaps because you can place stops below a gap's range or a key moving average that's nearby. Like all trading, gap strategies are not an exact science. You need to be aware of false breakouts and breakdowns. You need to wait for confirmation in the direction of the gap before you enter. Keep in mind you can also scale in or out. We'll take a look at a variety of trade management ideas in just a moment. Waiting to see price find support and break through recent resistance provides a low-risk, high-reward entry. Because you can clearly define your risk and you have confirmation of support, it reduces the chance of failure for entering gap trades. Here's why it's important to wait for confirmation. You don't want to just jump in where support might be. This stock gaps up. We take the high-low range of the gap and create a support and resistance area. After gapping up, this stock falls below the gap range, closes the gap before finding support, and then breaks into new highs. Here's another gap that didn't work out initially. The gap is filled, finds support, bounces up, but now the low of the gap day becomes resistance. It's unable to overcome it, and it falls back down. When you're drawing support and resistance lines and you're watching price action, you want to ask yourself, where is the next logical support area? The first one's usually the gap range, the second one is usually the pullback range, and the third one would be the pre-gap range. Here's another example of a gap failure. Price gaps up, and the very next day it closes below the gap. It's never a good sign when price falls below the gap the very next day. Consider it a red flag. Here's another red flag. The stock is unable to clear the resistance and make new highs, then proceeds to fail. In this example, you have a gap and go where price gaps up, then it proceeds to close higher the next couple of days. Our new potential support and resistance area is the gap low and the gap high, but price falls below it. It catches itself before closing the gap, then proceeds to move upwards to its recent resistance area. It pulls back again and then finally breaks out above it. You want to wait to enter or re-enter until the prior recent high is taken out. When a stock gaps up and fails to find support at a new logical support area, you absolutely want to make sure that you wait for support to kick in somewhere and for there to be confirmation that price is able to break above that resistance area. Here's a gap up and a pullback. The first pullback is an inside day, and it creates a narrow zone of potential support and resistance. See, the next day it advances. Then you have a second pullback, which finds support at the first pullback's high. If a stock gaps up and then continues to make new highs over the next several days, you might really feel like you've missed out. So if you need more confirmation, you can always wait for a pullback and then for it to break into new highs. Remember, a gap represents an unexpected or drastic shift in control. It moves price significantly away from recent price levels. So you want to keep track of quality candidates gapping up during earnings season, and then be patient and wait for an ideal entry point. Start with a strong gap. It's great when a stock gaps up out of a base or through recent resistance, but it doesn't have to, as long as it's of significant size to prove that there's a shift in supply and demand. Over the next few days, you want to wait for the price to settle down and for Wall Street to lose interest. After a gap up, the stock's eventually going to pull back and test some new support area, usually 2 to 5 days later, after the dust is settled and no one's thinking about the stock. When that happens, start looking for inside days, doji days, or a large drop-off in volume. After an initial test or retest of support, you want to see price break through into new highs. It doesn't always occur, especially if the gap is really large, but shorter-term moving averages like the 5, 10, or 20-day will often catch up with price action after it's gapped up. You want to look to see if price will hold along a shorter-term moving average, and soon after see price rally up and away from it. Whenever you enter a gap trade, you need to think about probabilities. Who's trapped? How many months have people been shorting the stock? This can have an impact on your stock's price movement. If a stock has a large positive earnings surprise, it can catch a lot of short sellers off guard. Then they'll be rushing to get out of the stock anytime it pulls back. Chances are, if the gap doesn't fill within a few days, then more money will flow into the stock in the coming weeks. Furthermore, keep in mind that stocks that gap up 15 to 20% or more can consolidate or run sideways for several weeks or months. Now I'm going to share some examples of different ways to enter and exit gap trades. One way is to just jump in with a position. Another way is to scale into a gap. One way to scale in would be by mimicking the CanSlim percentage advance. On gap day, you could buy 50%. When it goes up 2 or 3% more, you could add another 30%. And then when it goes up another 1 to 2% more, you could add the final 20%. Or you could scale in based on support and resistance. When price appears to find support and bounces up and off of it, you could buy your initial position. Then when price breaks above recent resistance, you could add 30% more to your position. And a day after it breaks resistance, you could add your final position when it moves through to new highs. You can merge or combine these exit and entry ideas, but make sure you plan your trade and you trade your plan. You don't want to switch entry or exit points in the middle of the trade. So say you entered a gap, but the stock's not behaving properly. You could exit completely at your predetermined amount. You could just follow Can Slim and exit when you have a 7 or 8% loss. Or you could scale out by a percentage loss, sell a third when you're down 3%, another third when you're down 5%, sell the final portion when you're down 7%. Or you could do it by ATR. Say the average true range of the stock is $1. If it falls $1, you could sell a third. If it falls $2, sell another third. If it falls $3, exit your remaining shares. Or you could exit based on support and resistance. If you saw resistance at new highs, you could sell a third. If it fails to find support at the pullback low, you could sell a third. And then when it fell below the gap low, you could exit the remaining balance. Or you could just set your stops at shorter-term moving averages. If the price fails at the 9-day moving average, you could sell half. Then if it proceeds to fail at the 20-day moving average, you could go ahead and close out the rest of your position. And it's okay to use average true range or moving averages as long as it doesn't exceed the Can Slim 7 to 8% loss rule. There's a lot of ways to sell a stock and a lot of different sell signals. There are a lot of important defensive and offensive sell rules that you need to know about, and you can learn more about them at investors.com. A good place to start is the IBD University. Also, check out the IBD National Webinars that Lee Tanner did. Now we're going to share some ideas for exiting profitable trades. One way to do that is you can exit completely at a predetermined amount. Can Slim likes to take profits at plus 20 to 25%. Another way to do it is to scale out. You can scale out of your stock completely, or you can scale in and out around a core position. You can scale it offensively by using a percent gain. Perhaps you say, every time the stock doubles, I'm going to sell a third of my position. I know some traders that when they enter a trade, they start with a very tight stop. Then as they start to develop a profit cushion, they loosen the stop and try to run with the trend as long as possible. Then after about 12 to 18 months, or if the stock is starting to look extended with a lot of late stage bases, they'll start to tighten up their stop again. You can also sell defensively with support and resistance in mind. If a stock is unable to make new highs after a nice run up, or it's made new highs on low volume, you could sell a third. Then if it fails a recent support, you could sell another third. And then when it finally falls below a recent consolidation or base, you could go ahead and exit the position completely. You can also take profits based on moving averages. If there's a moving average or a boss moving average that's containing the bulk of a long run, and it's contained it for 7 weeks or more, or maybe even for several months, once it breaks that support, you could sell a portion of it. Then if it breaks a shorter term moving average, like the 20, you could sell. And then when it finally falls below the 50-day moving average, and for whatever reason is unable to get back above that 50-day moving line, you could completely exit your position. If you've entered a gap and you've decided that you will scale out of the trade if it starts to move against you, you need to think about where you might consider re-entering the trade if it starts to behave correctly. An aggressive entry would be when price finds and bounces off support. The probability of success will seem a lot better if that bounce comes in strong volume with a strong close and a wide range bar to the upside. Here's an example of a trade that initially was not behaving correctly. It closed the gap, then leaps forward, breaks above recent resistance, and starts to move up. You could re-enter here as it breaks into new highs. In this example, on day 5, maybe you scaled out when the gap open was undercut. But then you could re-enter when you saw support at the gap low and that price bounced up to take out the pullback high. After a gap up fails, it's very important that you wait for confirmation of support and you confirm that price is able to break above the resistance and take out prior recent highs. In this example, we had a strong breakout, several follow-through days to the upside, but then it pulls back below the gap low and finds support before it closes the gap completely. Once it breaks into new highs, you could re-enter. Here's another example. Perhaps you decided to scale out once you saw that the gap open was undercut. Price appears to find support at the gap low. It's unable to break through this resistance at the gap high. If you had waited for it to close above that resistance, it would have kept you from re-entering and possibly incurring a larger loss. In this example, price gaps up, falls through all the new potential support areas, closes the gap, appears to find support at the pre-gap high, but then meets resistance at the gap low and then falls back down. This is not the constructive price action you'd like to see on a gap. So remember, be careful, wait for confirmation, wait for support, and wait for it to clear resistance. Please keep in mind the idea here is to give you a basic framework to get you thinking independently and assessing what you see. With any technique or approach, you have to figure out what fits your objectives, your tolerance for risk, and your individual psychology. There are many different ways to sell. With gaps, I suggest you start with a short-term mentality and shift to a longer term as the trade moves progressively in your favor. When you have a stock that gaps up and then seems to find support along the 10-day moving average for at least 7 weeks, you should consider selling that stock or at least some of your shares once the stock violates the 10-day line. And by violate, I mean closes below it and then the next day undercuts that low. Many day, swing, and professional traders will sell if price violates the 20-day moving average, or if the 20-day moving average slope shifts from upward to flat or from flat to down, or if the 10-day moving average crosses below it. The 50-day moving average is used by many institutions as a place to defend the stocks they own. So if price falls below and stays below the 50, it's considered a sign of institutional selling, especially if it's on large volume. Some traders will wait till the end of the day or the end of the week to decide whether to sell a stock or not. For those of you who don't like the lag time of moving averages, you could consider regression lines. I just thought I'd throw that in. I know a few traders who use regression lines instead of moving averages, and it's worked out quite nicely for them. More importantly, you need to make sure that you know and understand IBD's 22 sell signals for offensive and defensive selling. You can learn more about that at investors.com. You never want to lose more than 7 to 8%, and you never want to let a profit cycle into a loss. Instead, exit and re-enter if conditions improve. Here we have 3 examples of buyable gaps. Gaps up, holds the intraday low, does not hold the 10-day moving average, so you could shift to the 50-day moving average. Here's another buyable gap. It does not hold the intraday low, and it fails the 50-day moving average. Until I got a decent profit cushion, I would consider scaling out as price failed at the 10 and 20-day moving average. I could have walked away at least with a small profit instead of a loss. Here we have a huge gap up on large volume. It holds the intraday low. Because it never undercuts the intraday low of the gap, you might consider staying in it. The stock really never seems to be contained by the 10 or the 20-day moving average, but it does stay above the intraday low of the gap, and then it does seem to find support right around the range of the first pullback. That might give me the confidence I need to hold on until I can start to develop a profit cushion and then shift to the 50-day moving average. Here are a few things that help us increase the probability of success. When the general market is in an uptrend, when the stock sector is in an uptrend or accelerating or is a leader. A leader would be defined as being in the top 6 sectors. The stock's industry group is in an uptrend, accelerating, or a leader. It's considered a leader if it's in the top 40 to 50 industry groups. Leaders are performing well. You can find information about sectors, industry groups, and leaders in the IBD paper. The stock is fundamentally strong, accelerating, or a leader. Some places to find leaders would be IBD 50, Big Cap 20, Stock Spotlight, the Smart, NYSE, and NASDAQ tables, Stocks on the Move, and the IBD Time Saver table. The stock is in a solid uptrend or constructive consolidation. The gap is large. The gap volume is huge. The gap close is strong. The stock gaps up out of a base, constructive consolidation, through a resistance area, or off a key support. You want to see the gap hold above the intraday low, and it's even more encouraging when the gap holds above the first pullback low. And one of the most significant indications that your stock is on the right track is when it follows through to the upside the next few days on big volume into new highs. There are also a lot of forces that are working against you to decrease the probability of your trade success. Late bull markets or bear markets, market, sector, and industry groups that are going sideways or in a downtrend or decelerating, fundamentally weak or lagging stocks, volatile directionless stocks. Small gaps tend to be choppy and fail. Gaps with low volume or weak closes tend to fail. Gaps from late-stage bases or long extended moves don't tend to perform well. Gaps falling below their intraday low are inclined to fail. A gap up followed by an immediate gap down is never a good sign. Gaps that don't decisively hold the first pullback after the gap don't usually do as well. When you have a gap and there's no follow-through to the upside within several days, or the stock has large overhead resistance, may fail more. When price closes below the 50-day moving average, they violate the gap, and that's a red flag. And gaps that are up more than 20% may consolidate or run sideways for several weeks. Gap ups often seem too high to buy, but they're often a sign that the stock is in demand by institutional buyers. Earnings season is a great time to be on the lookout for gaps. Gap ups often lead to sharp, sustained price moves, especially with stocks in first and second stage bases or consolidations, as the stock starts to make new highs or at the start of a new bull market. Gaps that occur in fundamentally strong leading stocks with constructive technical action during an uptrend have the highest probability of success. Conversely, gap downs often lead to sharp, sustained price moves down, especially in stocks in fourth, fifth, or later stage bases, and during a bear market or correction. Don't be afraid to adjust these gap strategies to fit your objectives and psychology. That said, stick with your chosen plan and adjust it only after your post-analysis process or historical precedent research indicates you should, and be sure to always follow your CanSlim rules. Always define your risk, 7 to 8% maximum, and be on the lookout for other sell signals. And consider taking partial profits at logical places, like plus 20 to 25%. And remember, always keep learning. Investors.com is a great resource and place to get you started. This concludes my presentation on gaps and earnings season. Thanks for watching.